Okay, guys. So first I wanted to ask, have you taken any loans yourself, personal, either a credit card loan or mortgage loan or car loan? So do you remember what was the interest rate on the loan? Mortgage 1.8, mortgage 1.8, car loan? Nobody? Credit card loan? Okay, so the thing is, interest rates are very low currently. Money market interest rates, especially in Europe, are really, really low. Federal Reserve just lowered interest rate in the United States by 50 basis points, that's 0.5%. That's a significant thing, but still, that's almost 2% higher than in Europe. And I'm here to present a solution how we can capitalize on the low interest rates and take these interest rates to the crypto world. So basically, there is a market called crypto lending. Is when you take your assets, Bitcoin or Ethereum, and you get a loan in something as a stablecoin instead. There are various use cases why people do this. First, they don't want to trigger their tax event. If you sell your crypto for fiat, usually you trigger a tax event, you have to file your tax forms and pay a higher tax rate. Also, people tend not to trust centralized exchanges. Centralized exchanges get hacked every other week, month or so. So an idea to get a loan through a DeFi platform can help you do leverage trading. You can borrow some stablecoin and then redeploy that capital into the market without having a centralized counterparty exposure. Also, pawn shops type of analogy where people just need some short-term cash. You hold crypto, you don't want to lose ownership of it, you don't want to sell it, but you need some emergency. You have some emergency, you have some medical needs or travel needs, and then you go and borrow. And that resulted in a significant rise of that market for the last couple of years. That market was not existent 2 years ago when we started creating a stablecoin product. But now it's valued around 7 billion for both centralized and decentralized lending facilities, and decentralized lending protocols like MakerDAO, Compound, DYDX, total 1.3, 1.4 billion right now. And that's a significant growth since last year. Now, why the interest rates are so high in crypto markets? Because the interest rates in the traditional markets in dollar is around 2%, in euro we know it's negative. Some people even pay to store money in a bank account, so why can't we transfer those interest rates to crypto? We decomposed the risks that arise from accessing this crypto lending market and addressed one by one. If you studied finance, you know that every interest rate on the market starts from risk-free rate. So you can have your cash always deployed at the money market rates at a risk-free rate. Usually it's the rate that government bonds pay, or your bank deposit literally pays you, but they, in a sense, take it from the government bonds rate. So when you give your bank some money to put on a deposit, they buy government bonds for you. So that's called a risk-free rate. And global mortgage rate is around 3%, very low. Car loans rates are around 5%. Why they're so low relative to the crypto rates? In the crypto markets and in mortgage markets and the car loan markets, you have collateral. The platform that gives a loan instead of the crypto is an over-collateralized loan. So these are the loans that are the safest one on the market. When you have a credit card loan, it's not collateralized. In some sense, you may spend all of the loan the bank has given you and not pay him on time, the bank on time. And then the bank will have to hunt for you and take some assets from you, liquidate them and pay for the loan. But in crypto, the loans are given at almost 3 times the collateral the borrower provides almost 3 times the loan value. So why the interest rates are so high then? Because it doesn't make sense relative to the other collateralized loan markets. So first there is the risk-free rate, like I said, and in dollars it's already by 2% higher than in euro. So using something like Euro-backed stablecoin makes a lot of sense because we can already lower the interest rate, the risk-free interest rate by 2%. Then there is the credit risk of a platform that does this. So the way we manage that, we partnered with a big auditor, and I know it's not truly a DeFi kind of solution, but this is the best you can get right now to attract institutional capital. Institutional capital thinks still in big counterparties and believes in them. And when you do an audit of your platform by a reputable auditor, institutional capital tends to believe you have less risks. So we did that, and I think that lowered the interest rate already. Then the network risk. We can't stop internet, we can't stop Ethereum, so that risk obviously remains. If you think Ethereum or Bitcoin can collapse overnight by 99%, you should not touch this market, you should not invest. Probably you shouldn't be here, but I think everybody who operates in the Ethereum space does not take this risk as significant. We all kind of accept it, so we cannot do anything about it, it remains. The regulatory uncertainty is something that we've been addressing over these 3 years, and we were behind the digital asset framework that was launched in Malta. Now France is following up on their agenda, but basically there is a competition now among European Union states, and we closely watch that and help regulators climb the learning curve in the digital asset regulation space. Then fiat settlement hurdles. This is very, used to be, and for some parts of the world continues to be a hurdle when you try to sell a Bitcoin or stablecoin for fiat. What we have right now is a platform that allows to send your stablecoin to several fiat settlement endpoints, how we call them, and you can exchange them to euros for your IBAN account in less than a few hours. You can try it for yourself if you download our wallet, but there are several intermediaries whom you can sell the stablecoin to, and for 10 basis points, 5 basis points, depending on the size of the transaction, you can get fiat quite fast. And then there is the privacy issue and cybersecurity issue, which most institutional investors still don't feel like comfortable with. But companies like BitGo, for example, rolled out a product for institutionals which allows to insure the assets that are held with that custodian. And that's really important because if you're institutional capital deploying some assets around the market, you need somebody to blame if things go under. When you're a small person, small guy deploying your own capital, you don't really care about custodians. But when you want to lower the interest rate for the market, which is in billions already, and you want institutions to commit millions and millions of dollars, believe me, you need somebody insuring that custodianship. And BitGo supports Euro stablecoin, and they insure accounts of up to 100 million per institution. Now, the market. I think it's one of the most fast-growing markets in the world right now, crypto lending, that will total more than 16 billion this year because of the significant underpenetration of this lending market. If you look at the global world assets and world debt markets, you see that the debt-to-assets ratio is much higher than in crypto markets. And if we just say that crypto stays at this price level, say Ethereum will continue to be priced at whatever, 200 per piece, and Bitcoin 10,000 per piece, this lending market still has significant room for improvement because of the drivers and the usages I outlined above. Think traditional markets. Elon Musk, for example, he hasn't sold significant share of his stock, but he financed all of his real estate and other investments by borrowing against his shares. Why? Because first, he doesn't want to signal the market that he loses ownership of the stock, right? He doesn't want to sell his stock so the market loses faith in the company. Second, tax reasons, right? Exactly what we have in crypto. And third, loss of exposure. If we all believe in crypto, we hold Bitcoin, we hold Ethereum, and we don't want to sell it to lose the upside it might have. So for these three reasons, the lending market will total 15 billion this year, and 30 billion next year. And out of that, maybe 40% will go into DeFi once more user-friendly interfaces will be developed. So we estimated elasticity. It's elasticity or sensitivity, how much of a market share one could capture by lowering the interest rate. Because as with mortgage example, at 10%, nobody will want to take a mortgage. At 5%, there are more and more people will take the mortgage. And at 2% or say 1%, I'm sure everybody and their brother will rush for mortgages if they manage to get such rates. There was a funny example in Denmark. One guy took a mortgage which was tied to the money market rate, and the money market rate dipped negative. Just not to give into more details, the guy literally received a payment for his mortgage. So he took a mortgage, he owns a house, and he received payment for it. Fascinating time we live in. So current interest rates are so high in crypto lending that by lowering them even by 1 percentage points, one could enjoy a significant increase in market share. This is the market as we see for euro-based lending, and we think we can capture 4% of the market by introducing this platform later this year. A little bit about the stablecoin that is backing this product. So it was launched 2 years ago. We have more than 32 million in outstanding emission. We have a team of 20 people, and the stablecoin was transacted for more than 200 million worth of value transfers over this time. And I think we are still the biggest ex-dollar stablecoin. Now some companies experiment with gold-backed stablecoins. I personally think it's a bad idea to introduce something like a gold stablecoin. I believe in two worlds. One is a true DeFi, say crypto-focused community that only accepts Bitcoin. But if you want to try to implement this technology in something tangible that can bring benefits to society short term, then stablecoins is the way to do it. And there are multiple other applications of stablecoins. We can talk a little bit here. So first, the markets they address stablecoins. Were crypto trades, crypto trading. People were reducing volatility of their portfolios by converting some of the assets into stablecoins. They were doing arbitrage between crypto exchanges by moving not cash but stablecoins between them. But opportunities in the lending market are a small fraction of what's available in fiat settlement and acquiring markets. Countries like Malta, Cyprus, even France, southern part of France, where a lot of tourists come in, they usually have high acquiring rates. When you swipe your card in a merchant, your foreign card, not only your bank screws you on the exchange rate, the merchant gets 3, 4, 5, even 7% less of the amount of the transaction because the local bank holds the funds up to 30 days and takes a really high acquiring fee for foreign cards. So this is definitely something what could be shortcut with something like a stablecoin, even in its current form. I know Ethereum network hasn't scaled to proof of stake and still not ready for thousands of transactions, but for these type of transactions, there is not a significant requirement for scaling. So these transactions can settle in minutes, sometimes in hours, if you pay, for example, for a boat rental or for for a car rental. You don't pay 10 euros, you pay 5,000 euros. And 5% out of 5,000 is a significant margin to shortcut this route with something like a stable coin. And then there is obviously e-commerce space and remittance space, which are also significant but require more capital and time to go after. But funny thing is, it's time where crypto-related products and this technology can really come out of just speculative markets that were used to do some illicit fundraising and pump and dump schemes and do something better for the society. So this is some estimation of the potential fees that could be collected by disrupting these markets. All of them are quite significant, and I suggest you to try our stablecoin wallet. It's a non-custodial solution which allows you to transact with Bitcoin, Ethereum, all major stablecoins, and of course the Euro stablecoin, which will be available for purchase via credit cards in the wallet this month, and already available for purchase via SEPA. And if you email to wstasis.net your Ethereum address, it's w@stasis.net, we're happy to send you a promotional EURS coin, €1 per person, just for you to play with it. With that, I'm opening it for questions. Hope it was interesting enough. Any questions? Bitwala is actually developing their own solution for crypto lending because they have an exchange. Sorry. So they were really interested to know what we are doing. Yes.
So when we look at traditional markets, it feels like for the last years we were starting from the books that were barely ever mentioning that negative interest rates are possible. It almost feels like the access was just not there even to look at those charts. So are we just repeating the same possible scenario and not thinking about possible negative interest rates in the future on the crypto world? Have you tried to analyze such a situation?
Very good question. Well, listen, I'm not a fan of the central bank policy myself. In fact, I was a hedge fund trader, and I discovered Bitcoin in 2012, 2013, when central banks were doing quantitative easing rounds all over the world. And I thought, this is a perfect deflationary asset that could increase in price significantly. But reality is that to do successful business, you need to figure out some arbitrage. When somebody is selling coffee, it's also an arbitrage. They're buying some beans, they're buying some water, and then they're reselling it at some market margin rate. In finance, it's the same. When you do arbitrage between exchanges, or you do interest rate arbitrage between, say, emerging market country and developed market country, you also capture two sides of a trade with some risk, and you wait until that difference realizes. So my job, as I see it, is to make a system friendly and safe enough so institutional capital can go and deposit into the stablecoin space, into the crypto space, significant capital. And we have clients who've been asking us for this solution and asking for 1% or at least 2% rate so they can deposit billions. There are billions of capital sitting on the sidelines just waiting to get some yield. It's so painful when the interest rate is negative and when you have billions and billions of cash, of treasury management, which you have to deploy somewhere, and you have no collateralized assets to deploy them to. So our sensitivity is that at 1% deposit rate, there'll be at least 200 million of liquidity available to the platform. At 2% interest rate, there'll be 1 billion of euros available. So that will be more than enough for crypto people to start and borrowing that, say, at 3 plus, and it will be a 3x improvement of what compound charges now. So back to your question, I disagree with the central bank policy, but I cannot fight it. I created a way to capitalize on it.
The question is more about, Sorry, the question is more about, it is possible that you would capitalize on the markets also with negative interest rate, assuming everywhere would be -5% and you would be offering -2. So the question is more like, do you think that we already have models in place or thinking of the models to include potential negative interest rates on the chain in your product, for example? It would still be beneficial for customers potentially.
The stablecoin product cannot work with negative interest rates because you have to deflate the number of coins that are in circulation, and it's not really clear how do you you just subtract from everybody a small amount every day. So I think the crypto space totally is not ready for the negative interest rate environment, but there is so much opportunities to bring those rates at least in some equilibrium between what there are in capital markets and in crypto world. Yes. Sorry. It's okay.
I didn't. Yeah. Sorry. Since I was late, I didn't really pick it up. How do you swap from negative interest rate in the euro and get to the positive rate on stablecoin?
So. Okay, so the negative interest rate in the euro zone makes a significant demand available for products that are 100% collateralized or even over collateralized and yield at least 0. So there are people who are saying, guys, sell me something that yields 0, I just don't want to pay negative. We are saying, look guys, there is some asset that is 100% backed that yields 1%. How much can you give us? And they say 100 million. Okay. And then we ask, okay, what if it yields 2%? They say 1 billion. And it's just the tip of the iceberg because European money market funds have 3 trillion in euro cash and all that is negative. So the stablecoin is the solution. You need something as an intermediary asset to pool customer funds to be available on chain with the resulting rate. Of course, at the end of the day, somebody has to buy a digital token that will be a representation of euro on chain.
I understand the demand, but I don't get it from how you technically, from financial point, how you technically do it.
ERC20 token? Sorry, what's you asking? We put on one balance sheet liabilities in form of the tokens and assets in form of governmental securities. In fact, we executed on the Libra vision of...
But your stable coin is linked not to dollar, is linked to euro?
Yes. It's linked to the amount of assets the issuer has. And issuer has governmental securities issued in euro. Similar to Libra, but in Europe. And we are live, and we have not PayPal, of course, yet, but some counterparties who support us, and we are growing. But I agree actually, when I thought about a stablecoin 5 years ago, I watched Tether, and I saw how one could touch this disastrous asset. I mean, its credit risk, it's enormous. I wouldn't hold it even overnight for a second. But apparently people hold it. People think music plays, chairs are standing. When the S hits the fan, we'll be able to find our chair. I watched the 2008 meltdown, where people could not find a bid for a AAA paper. Yesterday, it was trading at par. Now it's trading at 15, 16. So I think the same thing will happen with Tether, although I don't know when. It's impossible to predict when, but at some point in time it will trade 98, 97, and then all the way to 15 or whatever, because nobody knows how much collateral they have available. And the concept of the stablecoin I created was totally contrary to Tether. The market was there, it was obvious, but I created an institutional-friendly product which institutions can touch and feel comfortable trading. Now, yes, crypto market still thinks in dollars. 95% of trades are still happening in dollars. But it was the same with emerging markets. When Russia started listing equities, they were first trading in dollars. But now most of the Russian equities are trading in rubles. So I think crypto market is so young. That's why it started trading in dollars. But once time goes on, there'll be differentiation. Also, Europe is lagging Asia and US in adoption. So Europe is the lowest crypto adopted destination. It was US with Bitcoin and then Asia with Ethereum. So it's Europe's time to accumulate more crypto and start thinking in euro terms. So we all think of Bitcoin in dollar terms. That will change.
Sorry, so if I understand correctly, there is no euro in a bank account. It's instead euro are being used to purchase government bonds?
Yes, so when you hold euros in the bank account, the maximum thing you can get if the banks goes under is 100,000 euros. That's the maximum insurance thing. But securities, they tend to remain in value for the longer term. So securities are much better asset preservation collateral than just euros in the bank. Because with the bank, it's not your money you store in the bank, it's the bank's money. It's the commercial bank risk you are taking. We can talk about that. We have several...
I'm sorry, but we're running out of time, and if you have any more questions, maybe you can reach outside. So I'm sorry, we're running out of time.
Okay, thank you for questions, guys.
I'm sorry to cut you off like that. It's just protocol. Yeah. Now you have everything. Yeah, you don't have wrote anything here. You're good. Wonderful. C'est bien passé. C'est manage correctement. Bon, après, je sais pas qui fait quoi avec tout ce matériel. Là, c'est vous qui gérez tout.
Ouais, c'est ça.
Nickel. Bon, bah, parfait. Merci à vous et puis à demain.
Tu reviens demain, toi?
Ouais, je serai là demain soir, pareil, dans la même salle. Donc,
Même salle,
ouais.
c'est ici.
Ouais, je fais la même chose, même salle. Donc,
Bah, du coup, ouais,
je devrais